Okay, welcome back to another Everyday Growth Advisors webinar, Sunday webinar. Welcome back. Hope you guys are having a great weekend. Just doing a quick recap for you guys ahead of this market open on this week. As you know, many of the research and analysis that we do is mostly on the weekends because Monday is too late to do it. So I'm going to share with you my quick rundown of what I'm going to be expecting for this coming week ahead. And also kind of recap what happened last week. Therefore, we can get a good kind of a personification of what's going to happen this week. So S&P 500 hitting record highs this week again at the 41.95. We finally hit our target on the 61.8 extension from this swing low to swing high. Looking at a possible pullback here for a continuation of a run. However, this week, remember, it is majority of the big earnings which are going to be reported. So we have a whole bunch of companies which are reporting, some of which are going to be Snapchat, Netflix, P&G, Johnson & Johnson, Coca-Cola, IBM, United Airlines. We also have some of the residual banks, Nasdaq, Las Vegas Sands, Whirlpool, NEE. These are all great companies. And then also Southwest, Seagate. So we have a whole bunch of these great companies that are reporting. American Express as well. Remember that in these environments, credit card companies and financials tend to do better in an inflationary environment. Especially when bonds are this cheap, they have the better half of the equation. Okay. Also looking at last week's performance of the market, also economic activity. Just want to kind of summarize everything for you and hope that you can get a good glimpse of what has been happening. Last week we had producers price index up about 1% month over month, about 4.2% year over year, signaling a stronger economic growth from the pandemic. And then services sector also showing a very good rebound, actually up 8.4% from February, with all service industries showing growth and expansion, which is something that is extremely important. The services sector is something we want to see grow. And so I want to highlight that that we're seeing the pent-up demand start to catch up here as we see it inch through the cracks. Also, strong March ISM manufacturing numbers, which was ahead of the analyst expectations at 64.7 versus 61.5, which is a record high for the past 37 years in this market, reflecting robust manufacturing growth, which has been stimulated by strong economic activity and orders, production, and employment in March. Unemployment numbers are also looking okay. And Chinese GDP was up 18% roughly, slightly below expectations, but signaling a strong economic recovery ahead of the peak rebound. Okay, so where are we at in terms of the S&P 500 technicals here? Let's just have a look real quick. This is the S&P 500 index. We've had a pretty big run up here. I'm looking on the 4-hour, but we're going to look at the daily chart right here so that we can also make sense of it. You can see we had a very nice uptrend here, which we broke out of, and we've been trying to move higher and higher. The reason why I like to use the 4 hours is because I get more information in the chart and I can kind of draw my fibs a little bit more graciously. So we're looking at this swing low here to this particular swing high here. This was the previous swing high where we had some consolidation. I could have taken this swing high as well, but this swing high was not present when I drew this fib. Therefore, I went with this swing high here. And remember, fibs are all about perspective. You could use any swing that you like, but I prefer using this swing because these were the two swings that were immediate after the breakout. This was a consolidation phase, the first consolidation, which led to a 61.8 extension, right? And the 61.8 extension now has reached a full extension. This was our supply zone. If you remember, we drew this in the last live stream, and we finally have hit that supply zone. And we're starting to see a few consolidation candles here. A couple of wicks on the top, a couple of dojis, and we will have to see if we can continue this run up. Now, there are a couple of things that are weighing on my head as I go into this week. Number one, the earnings season has been almost fully priced in at this point. Okay, what does that mean? That means, and remember, for people who are just tuning into the market, you're not so savvy with what these terms mean. I like to explain it so that you understand what I'm talking about. When we say that things are priced in, we assume that the stock market will include the price of these earnings performances before they happen. That is typically how the market works. When information is presented, it is priced in. That's what we call priced in. When something is about to happen, the market starts to already speculate. And when speculation happens, then it goes either way. If people are speculating to the upside, then you have one of these, right? If people are speculating to the downside, then you have one of those, right? And so right now, the market is speculating that this earnings season is going to be better than expected. But we don't have numbers. Okay, we do have some numbers. We have numbers from the banks, which is good, okay? And the banks perform better than expected. They actually perform better than expected because they were able to release their reserves from the pandemic-driven reserves that they had to keep. Now, this is something that drove their income up, okay? But we're going to have to see how the rest of the earnings season goes, right? And so if companies start to perform better than expected, then the market will have a melt-up situation. We'll continue to go higher and higher. But if we start to see, businesses report earnings and they start to do a little worse than expected, or, we see them perform a little worse than expected, what's going to start to happen is the market's going to start to correct downward. Now, is that going to be like a meltdown, or it's going to be like a sell-off? Probably it's going to be a nominal correction. Now, why do I say this? Because the market needs a wave down in order to continue for the next wave up. And what a better way to do that than when we see the earnings results. So what typically does happen during these times is, and this has happened countless of years, through the years that I've been trading, you see this pattern over and over again. Market prices everything in, earnings come out, even if companies perform good, market comes down, takes up all the stop losses that are right here, market makers force the price action down, causing some fear, causing irrationality, causing confusion, and then we start to move back up again during the month of May and June, okay? This is something that typically happens. Also, then you have the thing where they put out there, oh, sell in May, go away. There's also that phrase, which is commonly thrown around. But if you see historically, May is actually a pretty strong month for the stock market, okay? Just to reiterate what I'm talking about here, if you look at this seasonality index for the S&P 500 here, you can see exactly what I'm talking about. April and May tend to be very, very good months for the S&P 500, okay? Seasonality based on 30 years, okay? 30 years, we're talking about 30 years. So, oh, sorry, this is 20 years, but there is one for 30 years as well. Looks very similar, okay? And then you can see in May, June, July, we see a period of consolidation, perhaps, corrections, etc., etc. And then August, we see another expansion. October, we see another dip to buy again. And then in November, December, we get the Christmas rally, which usually ends up with the market ending higher, okay? This is typically how the seasonality of the S&P 500 works. But obviously, we can't say that this is going to happen over and over again. But if you look at it, though, what has happened since the beginning of this year? We've been actually following this pretty well, right? January and February were actually better than expected. March, we had a kind of a correction. And now in April, what has happened? We've seen a big melt-up, right? And in May, we'll expect some sideways movement as we continue to report earnings. And then in June, maybe a quick sell-off to correct downward. And then run up to the end of the year. Okay, so this is what you have to keep in mind. The seasonality of the market is something that you have to keep in mind. Okay, so what are the key levels that we can retrace to? Okay, well, pretty simple. We're looking at the retracements from this Fibonacci here. We'll have to plot another one from the extension from the upside. When we see the S&P 500 topping out, then we can see a retracement zone back down here. Now, what would that look like? Roughly, if you were to draw that fib to the downside now, let's say we get rid of this one, and let's just say, assume, we are going to make an assumption that this is the top. And if we draw that fib to this point here, down to the swing low, and we can consider a lot of points swing low, but we would consider this point the previous swing low on the bigger time frame. We would see probably about a peak of a 50% retracement. So we'll see a possible retest of the 4021, which is the 200 EMA, right? The 200 EMA is sitting right here. You can see my blue line is the 200 EMA, okay? But before that, we would have to clear a few key hurdles. Now, what are the key hurdles that we have to clear? The key hurdles that we have to clear will be these key levels. The first level would be the 4123, which is down here, and then after which we would have to clear this next dual zone, which is the 4089, and then the third, if we break through all of these, then we would go down to the 4052. Okay, if we clear this, we're going down to the 4000 odds, and that would be the last line of defense for the S&P 500 before we see another wave to the upside. Okay, so remember that these sell-offs happen much quicker than the moves up, right? As the saying goes, we take the stairs up but the elevator down. Okay, so that's one of the key things that you need to know. Now, as I was mentioning, we are trading upwards of this channel here, and also the Bollinger Bands. We're starting to touch this to the top here. Realize every time we get close to these Bollinger Bands, or start trading above it, we correct downward, and so we are kind of pushing up on this Bollinger Bands pretty heavy right now. I like to only use Bollinger Bands for witnessing where the extension is in the market, but we have broken out of this upward channel here. And so coming down to this key level here at the 4023 and testing it as a support is very, very nominal. So remember, you may see a quick flush down before another wave up here to the 4123 level, which is the 78 extension, which will now become a support level. This is also a previous level of support here. You can see a very strong support. And this will be a key level for the S&P 500 to come down and bounce on. It will also coincide with the 50 EMA in the short term on the 4-hour chart. Okay, so this will be the key levels on the technical side that I will be watching in this week to see if we can get a bounce back down there. Okay, the consolidation here signals to me that we may be seeing a little bit of a corrective wave downward to kind of get down to this point here before we see another upside. If earnings though present themselves and everything is great, then we may continue to see melt up, right? It may just keep going up and up and up, and that wouldn't be surprising to me. Okay, it wouldn't be surprising to me. Okay, great. From a macroeconomic standpoint, everything looks great, right? All the grooves for the key are looking good. Market looks pretty well priced in. For majority of situations, we just need to make sure right now that pandemic-related troubles are not going to get out of control, right? Cases are on the rise, so that could be a news cycle stimulus to see the market go down this week. Remember, as the news starts to cycle bad news, we've been seeing a lot of good news, but once we see like the news start to cycle bad news, that will be a good, idea for you to just kind of take hedges, right? I already do have hedges because the market's already overextended at this point, slightly overextended, but it's always good to hold hedges for a corrective wave down, and then you can cash out those hedges and start playing the upside again, right? So those are the things that I'm looking at. As well, another thing that you need to keep track of here is commodities. One specific commodity is gold that I'm watching. Been selling off pretty hard, coming down to a key level of support. I think it can sell off a little bit more. This is the monthly chart. Nice little cup and handle here. Looks like we may see a continued slide before we see a buy up. And I think this region here, the 140s or the 150s, 140 to 150 is the levels at which I would be comfortable taking gold. 160s here are still, it's been still bobbling around this downward channel here. So we will continue to keep gold in mind. Now, why is gold important one here? Well, commodities such as gold tend to outperform in the environment where inflation is present. And so you got to keep track of gold as a safe haven asset, even though Bitcoin is something that people look at. Remember, one of the biggest reasons why I keep telling you guys the reasons why I don't trade Bitcoin or why I don't invest in Bitcoin is because of this, right? It's because of this. Right? Look at the look at this movement that just happened over the weekend, right? Look at this, from what, 65,000 to 51,000 in a matter of what? Let's see. It was a pretty big drop, right? Pretty big drop. In a period of 3 days, this thing dropped 21% of its value. So this is a thing that I can't fathom. Being an investor, this is not something I would invest in. However, listen, it's not about me talking about investable things. If you're day trading Bitcoin, hey, this is the best thing you can day trade. And you know what? Power to you. All the people who trade Bitcoin on a regular basis, you guys, really hats off to you. Like, honestly. The thing is, for me as an investor, I primarily I would think of myself as an investor, but not mainly a trader. I think my trading days are mainly over. What I do now is sell options against shares that I own. And so for me, I have a completely different strategy when I'm investing in the markets, and I don't look at short-term punting anymore. My speculation days are over. I used to speculate a lot in the prior, and I understand that speculation is how you grow your portfolio when you're just starting out. But remember, right now, it's a bad time to be speculating because the market is pretty overextended. You don't want to be speculating on things that are this volatile, okay? And so I'm just voicing a concern that you should be careful when you're dealing with assets that are more volatile than the actual asset that you used to purchase it, okay? And what do I mean by that? If Bitcoin is more volatile than the dollar that you're using to purchase it, because this is Bitcoin USD, then this is a failed asset, right? You cannot purchase something where it is more volatile than, and when I'm talking about purchase something, I mean for investment, long-term investment, okay? You cannot purchase something that is more volatile than the asset that you're using to purchase it. So, in other words, if the dollar was more volatile than Bitcoin, then Bitcoin would be a sound investment. But because Bitcoin is more volatile than the dollar, this makes it a very erratic investment. So from an investment standpoint, something that I want to hold for a long time, I just don't see the merit. Reason being, there's a lot of things, right? And for people who day trade this and who are invested in it and who have made tons of money, congratulations. Seriously, you made a great penny, and congratulations, that is great. For me, I personally stick away from things that can move 20% in 3 days, because this is not the amount of risk that I want to take on for my long-term portfolio or my trading portfolio. And it's simple as that, right? Everybody has a risk tolerance. If you have a great risk tolerance, you're willing to take the risk, you get the reward. The higher risk, the higher the reward. Simple as that, right? And so with Bitcoin here and the S&P 500, you can see a lot of interchangeable common characteristics, but this is a little more stable, and that's why I like it, okay? Great. Well, those are the few things. Now, other tickers that I'm looking at for this week, I just want to put it out there. Apple has a event that is going to be happening on 20th, which is tomorrow. Well, day after tomorrow for you guys. It's been consolidating in the channel after a couple of retracements. We may see a corrective wave down before a run up. If the event is underwhelming, then expect Apple to slide down. That may be something that may occur. Amazon has been looking pretty nice as well. Had a corrective wave and may move to the upside again this week, ahead of the earnings, which are coming up on the 29th of April. So we have about 1 to 2 weeks, so 1.5 weeks more. Tesla has been looking very bullish lately. This is something that I also pointed out on the Instagram stories, and you should definitely be taking a look at this one. It could easily make a run up to the 800s again. It made up a run to the 780s before coming back down just to close this gap. There was a gap right here. I don't know if you saw it. It came up to do a gap fill and then came back down for a corrective wave. So this was something that we were also looking at. Another couple of tickers that I'm looking at this week, Fastly is one of them. This has been consolidating nicely in a channel here, and we want to see this break to the upside. I'm going to be putting a alert right above the $78 level here to see if we can break above. I will only take Fastly upon the break of this level and move back down to consolidate as support, testing this as a new support after breaking out of resistance. Signaling the price action to the upside. There is a big gap here to fill at the 91, so there's a lot of time and there is no need to rush into this. I would say wait. It's forming a nice little pennant on the 15 minute here, you can see. So it's a nice little pennant. This will be a possible violent breakout to the upside. We'll see if that actually comes to fruition. D-Dog is the other one that was exhibiting this behavior last week, but then we got an abrupt sell-off in this big up channel here. Came down to test this channel again. Once again, D-Dog here consolidating above the EMAs though, and consolidating above the resistance at the 90s. So we'll possibly see another pop here in D-Dog. Has been very volatile. This is another. And we're going to be covering Beyond on the live stream this week as a possible move to the upside. I will be doing the analysis on this and the valuation on Wednesday, so make sure you check that out as well. Remember, our courses are open for enrollment. You can also check it out on learncompoundgrow.com if you want to join us and take a look at what we are learning and teaching in these mentorship courses, where you can get to trade with me one-on-one and also learn from me what my methods are, risk management, etc., etc. Okay, so those are the few that I will put out there. The rest of the tickers that I'll break down will be in the live stream, and I hope to see you there. In the meantime, I hope you guys have a great day. See you guys on the trading floor. Remember, keep your risk light. We had OPEX last week. This week should be a little better of a week ahead of earnings, and I think we might get another move to the upside. However, a pullback is also necessary to move to the upside, so it's going to be a little bit of a mixed bag. I think volatility is going to continue, and I think that's good for the markets. So let's get this bag, and enjoy the ride to the upside. I'll see you guys back on Monday, and take care. Bye-bye.